Morning, Cecilia.
Good morning. How are you?
Good. So where are you, Cecilia? Oh, you're on mute. Sorry.
Sorry. I'm in San Francisco today. I'm back in Jackson on Wednesday.
Yeah, I hear it's snowing and raining there.
You know, the seasons have to figure out if they could only put the weather where it belongs.
Yeah, not the truth. It's chilly in New York.
Are you there now?
Yeah, I'm at Black Rock, next couple of days.
Uh-huh.
So I got out here so I could take this by video.
Is it Mark who's the chair of your board? Or
Yeah, Mark Stelnacher.
yeah.
Yes,
Great. He's a great guy.
yes, it's a good board.
We're doing 15C this May. So I was there last week and I'll be there next week.
We finished ours. Hello,
Madam
Tom.
Director, I see it's 8:02. I see we have a quorum. I don't know if, Mr. Treasurer, do we have everybody here that we need to have?
It looks so. Got some of the crew out there and back to the music when gets the floor.
We can't hear any of the audio from that table.
Well, thank you, Madam Director. Ben, do we want to do a sound check? Make sure we can hear everybody?
Mr. Chairman, we certainly can if everybody at the table would like to check their microphones.
I'm actually thinking about the Zoom.
We couldn't hear anyone from the table, Mr. Governor.
Okay, thank you, Mr. Opatroni. Can you hear us now?
I hear you fine all the way along. If someone from the table could, in facing
Okay.
you. could
Hello,
speak
good
up.
morning, Don. Tom.
There we go, Mr. Treasurer. Now we can hear you. Thank you.
All the crew.
Okay, that's probably a reminder to make sure that you press your mic on so that people can hear. Very good. Well, with that, Madam Director, I will call us to order and turn this over to the good treasurer.
Thank you, Mr. Chairman. I guess what we're going to be looking at is asset allocation here. And I want to start by thanking the Investment Funds Committee for their great work for the last several years at putting together a strong asset allocation. In that regards, normally your asset allocations are 3 to 5 years, but we've had a lot of changes in our reference portfolios and stuff. And as you're well aware of, Mr. Chairman, we've kind of have a 3 to 5 year rollout on those changes. And essentially we're not really asking for any changes of any sort, and just looking at the implementation of what's going on. And there's going to be some good discussions here with the IFC and our staff and RVK in some of the details. And we have the monthly investment performance analysis up first.
Very good. Would that be Josh who's presenting that?
Yes, Mr. Chairman.
The floor is yours.
Thank you, Mr. Chairman, members of the board. Good to see you here this morning. We've got a preliminary view of your March 31 results. And I'm going to start on page 3 of this document. It's a rather busy chart with lots of dots, different colors. And each of those dots represents a just plotting on an XY axis returns of US stocks versus US bonds on a quarterly basis going back to 1976. And they're also color coded by inflation regime. Green would be low inflation, red would be periods of high inflation as measured as inflation above 5%. And one of the main things I want to point out here is just how unusual this first quarter was. There are not very many quarters like this where both stocks and bonds are down about 5%. In fact, you can see there's really kind of 3 dots down there that stand out, and the other 2 were Q1 of 1980 and Q3 of 1981, back when really kind of the last time we had inflation at these levels. And it really just goes to show you that this past 30 or so years, we've gotten comfortable with this idea that bonds are a sort of perfect hedge against equity risk. And oftentimes they are, but in a period like we're in now where the Fed is more concerned, central banks globally are for the most part a little more concerned about inflation. They aren't necessarily in the same position to ease policy when the economy weakens. If you look at the numbers on the bottom of the page, you can see that here we've just rank ordered the worst quarters for the bond market since we've got data for this aggregate index. Q1 of 22 was the 3rd worst quarter in the history of this index, with a 6% loss on investment grade US debt. And if you look at some of the numbers to the right, we show you sort of yields and returns. And if you go to the far right, basically just saying, okay, what were the returns for bonds for the 3 years that followed these really bad quarters? Well, it was pretty good for the most part. But the one thing that's really different from those periods today is the starting yield level. Look at the yield to worst at quarter end at each of the ends of these quarters. Now, the yields are a little bit better, obviously, than they were when the quarter started, but they're still sub 3% or so, or right around 3%. Whereas back in the early 80s, those yields were 12, 13, 14%. On the next page, this is an update to a page I think we may have shared with you midway through last year, but just looking at how different assets perform in different types of inflationary periods. And there's 6 boxes with bar charts on the top half of the page. The top 3 are just breaking the market down into how do different assets do when inflation is rising, falling, or stable. And I would sort of characterize if you're looking at the colors here, green is at global equities, orange is stocks. Everything to the right of that is some asset that investors would typically believe have some connection to inflation. So things like commodities, real estate, et cetera. And, stocks and bonds do really well in stable and falling inflationary environments. If you look on the left, these other types of assets tend to do much better in rising inflationary periods. But there's also a difference if you look on the middle set here. breaking this down a little bit more, looking at, okay, what's the level of inflation? On the left is inflation below 2, CPI below 2, sort of medium in the middle, and then above 5 on the right. And if you look at that graph of CPI across the bottom of the page, CPI is solidly above 5 for the first time since the early 1980s. And you look at that sort of quadrant in the middle right of the page, when you've got high and rising levels of inflation, that's the period that's really bad for most financial assets, stocks and bonds, but very good for many types of real assets. And the good news is you've positioned your portfolios pretty well for this environment. You know, the page I just showed you had stocks and bonds down 5% in the first quarter. And last year's asset allocation changes, you introduced, well, you've made incremental changes over each of the past several years. But one of the big changes last year, the biggest change, was to reduce your core fixed income. Now, most of that core fixed income was going to private assets that are going to take several years still to build out properly. But rather than sit around in core bonds with duration of 6 and yield of 2, you moved quite a bit of that out of the way into this transition low duration account, as well as some in bank loans, which are floating rate. And those are holding up much better in this environment. And when we get to your returns, you'll see that in this sort of stocks and bonds, both down 5, your permanent mineral trust fund was down 1.6, which is a very good result for this environment. So if we go ahead to page 6, just a snapshot of the total assets, 24.6 billion, combining all of the funds together. And just as a reminder, the color coding just is used to differentiate the different types of funds and how they're segregated in your investment policy. Your green funds would be your long-term total return oriented permanent funds, such as PMTF. Blue would be your income-focused permanent funds, largest of which is the Common School Fund. Yellow is your workers' compensation fund. You've got Pool A, the LISRA, and state agency pool. Going to total fund performance on page 7. Total fund assets down 1.9. So that does combine everything together. And that combines together funds that have completely different purposes, timeframes, constraints. So the level of returns isn't really a meaningful number here, but the performance against the benchmark, that is what's telling you when you roll everything up, are you outperforming your benchmarks? And you were net of fees right in line with that for the quarter. And on a fiscal year to date basis, ahead of that by about 20 basis points. You can see in the chart on the bottom half of this page, the fiscal year, these are fiscal year to date numbers, just showing you performance by asset class for your assets, as well as the benchmark for that asset class. And just, I think at a high level, you see fiscal year to date, most assets are down. The things that are doing well, first of all, large U.S. equities, and particularly large cap U.S. equities, are still showing some positive numbers, although that has likely changed with April's numbers. MLPs, so commodity related ownership of midstream energy assets, those have done quite well. Real estate has done quite well. And then you look at things like bank loans, which are floating rate in nature. That's pretty much the only type of fixed income that's positive over this period. As you go to page 8, as I noted, permanent mineral trust fund down 1.6, and 70-30 was down 5.5 in the first quarter. Now, of course, you go out over longer periods, and 70-30 has done very well over the long term. You go to the Common School Permanent Land Fund. We've noted the performance divergence between the income funds and the total return funds over the last 3 years, and you can see there is still a pretty decent difference over the past 3 years. You do see that narrowing a bit here more recently. Common School down 1 and up 1.9 fiscal year to date. Workers' comp has the most fixed income exposure of the funds on this page, and is, as you've structured that, it has assets that are set aside to essentially mirror the liabilities, and then you've got a pretty substantial surplus on top of that. That's why you see the weakest performance in the quarter to date, because it does have some longer duration fixed income. But keep in mind, for that part of this portfolio, you're just matching assets and liabilities. So yes, those assets are down, but the measurement of liabilities will also be lower. LISRA down 3 in the quarter and down 2.2 fiscal year to date. You can see it's divided into these 3 underlying sub buckets: long-term reserve, intermediate, and short-term. Interesting that the long-term reserve actually is the best performing of the 3, even better than the short-term reserve. That's because any type of fixed income, outside of floating rate securities, saw losses in this period. You've got broader diversification, including some exposure to things like MLPs and bank loans in the long-term reserve. And then lastly, finishing up with Pool A and state agency pool, you can see also both of those down around 2%. So, Mr. Chairman, I'll go ahead and stop there. There's obviously much more detail we can go into. I'm happy to answer any questions you have or dive deeper if there's somewhere you'd like me to.
Any questions? Let me offer an opportunity for members of the IFC, if they would like to opine on any of this information, have a chance to speak to it. Mr. O'Patrony.
Yes, I'd like to go back to page 8, Josh, if you would, and I'd just like to make an important, what I think is a very important point here. Josh did a very nice job of discussing all of these asset classes, but I just want to be careful that people don't therefore draw conclusions, well, we shouldn't be in one asset class or another. This is the histograms, Josh, of the performance in various environments. Page, I think it's 8.
The inflationary environment.
Yeah, right there. Oh, you just missed it. There we go. I just want to make a point to all in the room, because there's various backgrounds. It's fine to analyze these individually, but the most important element is how they work together as a portfolio, because what you do not see here is the elements of cross correlations and the likes within these portfolios. And so when we see the performance of the actual total portfolio in these various types of environments, you will find that frequently we will do better than, in effect, just the sum, because of how these interact. And that's part of the approach and what leads to a dynamic of building a diversified portfolio, which is going to enable you to go through the ups and downs of the marketplace successfully, rather than taking a view that you're going to market time going in and out of any one of these individual columns. So I think, just to some extent, the next page would have been to show, given our kind of portfolio, what happens in these types of environments. But I think you would find that overall, it will lead to much greater consistency over time, particularly given the inability of anyone to demonstrate on this type of fund or funds an ability to market time. Thank you.
Thanks. Thank you, Don. It's good to hear your voice. And Josh, a quick question. I'm really excited that we made the changes we did. It took several years before MLPs sort of showed their value. They were certainly the dogs of the portfolio for a while, and we did change the I guess, the investment policy to really allow us to be able to take a couple of, and I'm saying this mainly for the superintendent who hasn't been on these calls before, but our old asset allocation said because we are so natural resource connected that you would want to sort of avoid the correlations that you would have by investing, let's say, in commodities, because so much of our other income comes from that. But we did take a bet on MLPs, which are slightly different, and I'm happy to see that they're starting to perform there. Another question, Josh, or anybody from, and it's good to see you, Dick, on. Thank you for being there, and Celia, welcome. And you know, kind of a perspective, because and Mr. Treasurer, I guess in my view, having gone through a very long period where money was easy, interest rates were low, then no inflation that was on the horizon, and suddenly you have a tremendous amount of volatility. You have a rising interest rate environment. You have a lot of uncertainty in the world. And so the challenge, I think, at this particular time for me is to think about what this means going forward with regard to this asset allocation.
Well, Mr. Chairman, I do have to echo Donald Patterney's observation. I think it's a very good one that we have that diversity within our portfolio, and that we may not have a race car on the track that's going to win the race every day, but we're always going to have a few on the track that'll be in the top. And so at the end of the season, we're going to do just fine. And I think that's really a testament to, I think, that the teamwork that we have in the process, between the staff that does a lot of work, and RVK and IFC that gets in there and fine tunes a lot of their work, and of course the Slib board, and then the legislature for allowing a reference portfolio that gives us the flexibility to start moving into some of these assets like we have in the last couple of years. I'd say we're roughly about halfway through rolling out this implementation of a more diversified portfolio, and there's a few other things that we might get, but we're getting really close to having I guess what I'd say is that oil tanker with an icebreaker bow, that it can go anywhere, and it's always going to be a valuable asset to the state of Wyoming.
Thank you, Mr. Treasurer. Patrick, any thoughts? I know when we were sort of starting out on this, the idea was in a rising market, it was always hard to know when to buy. It could always be good, but there could be a big shock. And we wanted to position ourselves to be able to be nimble to get into the market at a time when it was correcting itself. Do we have a potential correction coming at this point?
Thank you, Mr. Chairman. Patrick Fleming, CEO from the Treasurer's Office. Yes, in the next presentation, similar to what we do every year with the IFC and this meeting, we go through some of the allocations and what we're looking for in the big picture for the asset allocation. So if you would like me to go into the next presentation, we discuss the topics that you have brought up.
Perfect. Any other comments, questions? And the only thing, Josh, and I thank you for this. Oh, and I see Don has his hand up. But the only other thing, noting that at the time we were thinking of total return as a concept for the permanent funds, and then wanting to focus a little bit more on income for the school. But I had made the request, I think last February, that we just think about putting everything in one total return, because I believe, the legislature will intend to sell capital gains. So,
Mr. Chairman, we did take your prior request to a discussion with the IFC, and that was part of our discussion with the IFC on asset allocation this year, and will be part of our discussion during that part of the agenda today.
fantastic, Don.
Yes, Mr. Chair. All I wanted to comment on is kind of at a very high level. One of the aspects of building out this portfolio that we're referencing has been to slowly but surely increase equity and equity-like exposure. And we have been, in a sense, steadfast amongst the IFC and the Treasurer's office. There's lots of bid-ask differences of perfect timing, but overall, we've been establishing that both through various ranges of typical equities as well as in the privates area. So to the extent we want to continue that, I think we would urge that. And then obviously to the extent we see some type of downturns so that we can build towards that asset allocation on a more accommodative price. In the long run, that is advantageous. So we have to be kind of steadfast and not scared by the current environment as we go down that path. I think that's really the big issue, having the fortitude to carry on.
Great. Well, thanks, Josh. Go ahead.
So, Mr. Chairman, if we could turn to the asset allocation market valuation page, I believe it's in the back of your board books. Is that D2?
Yeah, the back D2.
So first, if we could start, is everyone on the pages? This is the presentation. Everyone knows the quilt chart that RVK puts together. One quick one before we start. I just wanted to acknowledge RVK and what they have done and the work that they've done for us on this, and also Greenwich Associates, which I think is one of the best consultant groups out there that looks at these different entities. And every year they do an analysis, and it's a very extensive survey because I'm part of it. They interview you for close to 30, 45 minutes and go through all of the different details. But once again, RVK was one of the top 3 consultants in the United States. And this is, I believe, 5 years running. So one thing I just want to acknowledge that it's nice to have the best of the best in the consultant world as well, and just acknowledge all the great work that they've done in putting all of this together.
Congratulations.
Thank you. So on the quilt, we've talked about this before, but looking at it, the historical precedents when you're coming off of the valuations where we've been and looking on a forward type of return analysis, we're just in a very difficult situation. When you have interest rates at very low levels, you don't really have anywhere to go but up, which is very negative. And when you have equity valuations that are, either the number 1 or number 2 highest that we've had in the history of the market, they typically have a tendency to mean revert. So when you look at this on a long-term basis, the typical 60-40 portfolio that people look at, or 70-30, whatever you want to use, has returned a 5% real return over the last 50 years. And as we get into the asset allocation discussion, looking at RVK's capital market assumptions, they are looking at a real return on a 60-40 portfolio of 1.2%. So when you're looking at the environment that we're in, it's just on a 10-year, we're not talking about, it's not a great 1 year or 2 year indicative situation where we are, but on a long-term basis, it is looking at a risk-adjusted return, which is one of our first priorities, is one of the worst that we've seen in quite a while. And I would highlight that if you look at this quilt chart, let's just look at the 2 top Sharp ratios, which is a risk adjusted return. It's the return minus your short-term rate over the volatility. And if you look at two of the top performers, for instance, a private equity had a Sharp ratio historically of 1.13, which is very positive. Anytime you can get a Sharp ratio close to 1, that's very positive. And if you look at the forward basis using the RBK's assumption, it's 0.24. Cash, 1.16. Sharp ratio is 0. I don't think I've ever seen a Sharp ratio of cash at 0, but it's, other than the 70 periods. But if you look at all of our asset classes, the return expectations are going down and the volatility is going up. So I just want to preface that what we're looking at, and as all of you have mentioned, we have this plan and going through, and I think we have a very good plan, but it is a situation where we're in a difficult starting environment after some tremendous returns. Okay, valuation, just where we are at this juncture, we always look at the long-term type of returns. This is equities. And if you look at the 10-year forecast, we're still probably in the, most of all of the different things that we look at would be more in that top quartile of expensiveness. So we're still very expensive as far as your quartile history would go. But I do want to highlight where we are, for instance, on a 1 year. We would be probably in the top decile of cheapness on a 1 year basis. And obviously we can't look at a 1 year type of return, but as we have started to sell off here since January, that the market is starting to get more reasonable on a long-term and more of an intermediate basis. On the next page, one thing that we will be discussing in the asset allocation, I just wanted to highlight this, is with the turmoil that we're seeing with the Russian-Ukrainian war and the causes that have the impact on the markets with inflation, supply chains, demand, et cetera. That one aspect of the US market is that we're 72%, the sales of S&P 500 companies, 72% of it goes into US companies. Where if you look at the international markets, which would be on the next page, it's spread across a much more diverse region and is much more impacted by these areas. Now, on asset allocation, we're overweight international markets, and this is a discussion that we've had with the IFC. But the flip side of that is the international markets are much cheaper than the US market. So if you're looking at a 21 current PE that we have in the S&P, where the international markets, Hong Kong is a 7.5 PE. You have, the CSI, the Chinese stock market, the European stock markets, they're all in the lower double digits. So it's many people are looking at it and saying, okay, well, this has already been factored in. And if you look at a year-to-date performance, you would say, oh, the European market has, or the ACWX, which is our index, has performed dramatically. Yeah, has been poor, much more poorly than the US. It's only underperformed the US by about 80 basis points during this period of strife. And that's just indicative of it's a much cheaper market versus the US, but it does have some issues. And so as we get into the asset allocation discussion, this is something that I just wanted to highlight for the members. On fixed income, same story. On a 10-year basis, fixed income markets are very expensive. But if you look at a 1 year basis, as we have sold off, they are in the top decile of cheapness. So, we're in this kind of movement from rich to cheap, and we're starting to see some actual valuation come through into the fixed income markets. So similar valuations, which we talked about on the PE side. On the fixed income side, your yield to worst on our Bloomberg Barclay aggregate, which is the core fixed income component that we invest in, that is a 3.6% return. So it's actually getting to a part where you're starting to get a return, and what fixed income is supposed to do in a portfolio, as Josh mentioned. So we looked at it before and we said, well, fixed income offers very little value when it's very low, because what happens in a recession, US Treasuries rally, and most of the other markets, the corporate bond spreads sell off, equity sell off, et cetera. So if we did go into a recession, that fixed income or treasury component of that would have been up a little bit, but it just didn't have much to rally. The bottom of 10-year yields were about 50 basis points at the time. So you don't really have much more to go from there. Now we're up above 3%. And if we did go back into a recession and went back to those low levels, you'd actually get about a 25% return on a 10-year treasury. So it's starting to offer value. Fixed income for the first time, you're starting to offer value there. Emerging market debt, dollar-denominated emerging market debt is now yielding 7%. Triple C's above 10% in junk. So that there's these sectors where you're saying, okay, now you're starting to be compensated for some of the risk with what's happening, default risk, interest rate risk, et cetera, in the fixed income side. The next part is getting back to the governor's question about the forecasts and, are we starting to see, are we going into the problems that we have talked about, the recessions? Well, this highlights that forecasting a recession has been a fool's game. It's been very, very difficult to do. And the best of the best has not been able to do it. So I can assure you, we cannot do it. But what we do look at is what are some of the factors that cause a recession? And historically, what are some of the indicators that will give you information about when a possible recession would come? Because as I just mentioned, recessions are typically very bad for equities, and it causes the corporate bonds and the spread, anything other than treasuries, to sell off. So on the next page, what we did is we looked back and said, okay, prior to a recession, what are some of the historical impacts, things that have happened in the market that have caused it? And so one, oil spikes, yield curve inversions, leading economic indicators, unemployment increases, and when the Federal Reserve starts to hike interest rates. So on average, after the first hike in interest rates, a recession occurs 2.5 years later. We've already had the first hike. Yield curve inversion, when 2 years versus 10 years go inverted, we've already gone inverted for a very brief time. The 1 year forward 2s, 10s is still inverted. So the market is still telling you it's possible, but at least we have a little bit of positive slope to that. The oil spike is the one that's really problematic. Historically, if you look back at all of the times when we've had oil spikes, when we look through, 1973, 79 Iranian crisis, 1991 when we had Kuwait invasion, and going back before the dot-com or the financial crisis when oil spiked up to $144. Those are typically really problematic for the markets, and it's one of the main causes for recessions. And we incurred recessions after those periods, and that's half of a year. And so we've already had that oil spike, as you know. So that one is problematic on numerous fronts because, as you know, the Fed, part of the reasons for the inflation is supply and demand, right? So the demand went up dramatically because of all the money that was put into the system from the government. And yet the supply side was constrained because of COVID, all of the other issues that we've had. And so the Fed can only impact the demand side of the equation. They cannot impact the supply. They cannot impact what happens to oil prices and so forth. So part of this big issue that we're having is, can they control inflation? No, they cannot. And so this is the conundrum that we're facing and the problem with the markets and why it is starting the market has come under so much pressure at the beginning of the year. So the countdown has started for the next recession. According to history, we can't forecast it, but on the next page, you can kind of see some of the things that would occur. And, most of them have already occurred. You already have seen that the spike in the oil, the inflation, the 10-year yield increase, the international and domestic market sell-off. The one kind of caveat is the dollar normally decreases, and yet it has increased this year. That's primarily due just to higher rates that the U.S. has been increased as the U.S. rates have gone up faster than other markets. Money has flowed into the U.S. dollar. So these are the issues that we face. So long roundabout answer to your question, Mr. Chairman, is the probability has increased dramatically. And if you look at many of the forecasts from the Goldman Sachs of the world or what have you, they're now anywhere, I've seen recent ones now up to about a 50% probability that within the next 2 years that we will enter into a recession. So, and historically that has been very problematic for equities and spread product as we talked about. So yes, is it around the corner? We just had a stellar unemployment number. US demand is still quite strong. You still, the debt levels of the consumer is not there. So the bottom line is the consumer is very good. The corporate sector has a little bit of debt, but you're not seeing the stress. So it doesn't seem likely at any time soon we would have one. But longer term, at Bank of England last week just mentioned, they just hiked 25 basis points and they said inflation forecast is going to be above 10% and we're going to go into a recession in 1 year. So these central banks are really in a conundrum where you're hiking interest rates knowing or forecasting that you're going into a recession. So it's just a different world, as Josh has mentioned. And during this time, volatility spikes, as we know, top decile in interest rate volatility. We're 33 on the VIX, which is extremely high. So the markets are just in a very uncertain period while liquidity is very low. So this is exactly what we've talked about over the last year or what have you occurring, and hopefully we'll have a portfolio that will be able to weather the storm during these difficult periods.
Mr. Chair, Patrick, can I add something?
Yes, Tom, good to see you.
Good morning. Let me be a little bit of a ray of sunshine on this. One of the things, we were down at the Milken conference, and I'm sure Patrick can opine on this. One of the differences or sort of ways to look at this is clearly in this high inflationary environment is inflation rising versus inflation falling. And when you look at periods when inflation is still high, but falling, actually equity returns for the subsequent year are actually almost as high as they are when there's low inflation. And so now that supply chains are starting to kind of get a bit of a grip on things, it wouldn't be surprising if equities actually do okay from here. And so again, it doesn't necessarily give a longer range forecast, but I would just say that I don't know if it's necessarily all completely gloom and doom. The big challenge, frankly, is, no one can forecast geopolitical events. No one should even really try to. And so that's really, frankly, the big issue. But I just wanted to add that. Thank you.
Mr. Chair?
Yes, please.
Maybe you add to Tom's comment. I'd make two. First is, Patrick, I would correct one element, which is all the statistics we've gone through are statistics that are symptomatic and tend to be or show some correlation to trends towards recession. They're not causal in their own right. So I think we should be very clear on that. And secondly, as the Wall Street saw goes, economists have projected 10 of the last 3 recessions. So I agree with Tom in that you really have to look through the underlying dynamics. And we're not speaking to some of the more causal dynamics, which is to say that employment is absolutely at full blast. Capital investment, particularly in technology, is at all-time records. So there are quite a few dynamics that, if nothing else, at least forestall the time frame of a potential recession, recognizing that recessions since the 1700s tend to occur about every 8.5 years. So it is a normal cycle, and I'll come back to my earlier comment. Therefore, we have to be prepared to work our way and have a diversified portfolio to work through these in any event and at all times.
Thanks, Don. And I guess the reason I had asked the question really wasn't worried about a recession. It was really worried about making the best of that recession, get ourselves in a good position. So, Auditor.
Mr. Chairman, Patrick, remind me in my ongoing commitment to ask dumb questions, what are the numerical objective markers that we know it's a recession?
Mr. Chairman, Madam Auditor, the definition is 2 quarters of negative growth is the definition of a recession.
Thank you.
And just to respond to Tom and Don's comments is absolutely, just talking about the ray of hopes and what we're having, the market is extremely oversold. If we could get any type of positive news out of Russia and Ukraine, this equity market could be up easily 15%, if not more. So there is tremendous short-term opportunity. All I was alluding to is the probability of a recession is much higher than where we were. And I would just follow what has happened historically and say that the probability of a recession in the next 2 years is non-trivial.
Other questions?
Yeah, Mr. Chairman. And I guess there might be some from some of the IFC members in that looking at, let's say we get some positive news in the Ukraine situation, and this is regard to international Europe, where a lot of the countries there are trying to implement some kind of a wean us off Russian energy. Assuming they continue to wean themselves off Russian energy, what kind of impact might that have on some of the European countries as far as their capacity to grow the opportunity in their markets? I know you've given this a lot of thought. You can get back to us later if you want.
Well, I would make a stab at it. There are a lot of considerations. I think. Okay.
Go ahead, Don.
Mr. Chair. I would just make a couple comments, Mr. Treasurer. Within the European markets, clearly there is a higher risk component. And as Patrick rightfully pointed out, therefore you've got lower arguable valuation components here. In terms of the energy, all of them are reducing their sourcing out of Russia. The biggest cost obviously is in Germany. And the issue is a couple-fold. One is alternatives are expensive, either from a cost perspective or from a sociological perspective in the case of nuclear. And the other point I would make, which we haven't spoken to, is that in these markets, and even in the context of a recession, there is an expectation that the dollar is going to be quite strong. And oil and energy is still a dollar-based commodity. And I think all of that paces the decision, if we were to continue to build out equities, whether we would not skew it towards the US. The last comment is obviously the outlook for globalization. The whole Euro concept was to make that much more of a competitor to the major countries, particularly the US. And obviously the recent activity and the recent trends are undermining that. So there are a couple other factors that lead people to be not quite as positive on Europe as a pure valuation analysis might dictate.
Thank you, Don.
So one other question, which I think I would love to have your impressions on, is obviously what the Fed's going to try to do to wrestle inflation to the ground. And I can remember Bernanke saying, "We have the tools, we know how to do it. We can fix this." And I've heard the same thing from Powell and from other presidents all along. But the pain that you feel on the ground with people and their mortgages, with operating lines of credit and all of those things is relatively pronounced. Do you see, I mean, I can remember back when I was on the Kansas City Federal Reserve, we were hoping to hike rates just simply to get a jump start in the mortgage market. And now, do you see there being sort of a flash? And then I guess I'm wondering what happens long term if we see emerging market countries starting to default, if we see people starting to default. Just curious what your views are on that.
Thank you, Mr. Chairman. I'll take a stab at it. If you just look at what the Fed is doing right now. So the chairman last week mentioned that they thought the R-star, the neutral rate of interest rates, is somewhere between 2 to 3%. And so typically what you want to do to get inflation down is to have your neutral rate above the inflation rate. So right now we're 8.5% CPI, and it's forecasted, as Tom alluded to, the base effects alone will cause inflation to come down. It highly unlikely that we stay at these elevated levels, but it still is talking about a longer term, intermediate term, next year, what have you, at around a 4% level. That would still be under the inflation rate. So that is still being stimulative on that side. Raphael Bostic, the Atlanta Fed, he thought R-star was around 2.5%, so still lower. So the Fed does not believe that they need to hike rates long and high enough above the inflation rate, because at that point they would definitely put us into a recession on it. Longer term inflation indicators, 5-year forward CPI is at 2.8%, 10-year break evens, kind of at that same level. The 5-year forward break even rate is at 2.5%. So all of the inflation indicators are saying that the Fed is going to be able to get a handle on this and keep inflation at bay on a 5 to 10 year period. The problem is this just very short-term period. And they feel that by hiking 50 basis points here, they just went 50, another 50, another 50. Once they get up to that, 2.5 level, the average board member feels that they could be at a level that would keep inflation at bay. That is what the Fed is saying.
So Patrick, if you look back, and I realize going into it, it's a lot different, but if you look back at the 80s, it took a certain amount of time before you started to see interest rate hikes. It's not a command, it's not a light switch. And I'm just curious, because they haven't done a very good job of predicting how inflation would react. Of course, there's been a lot of other factors in it. But is there anyone that's thinking that this could be a little bit longer term challenge?
Well, absolutely. Just go back to history. So as you mentioned, inflation was at 14.5 in the early 80s, in 1980. And so the one difference on that is that inflation at that time was changed in 1995. The Bostic Commission changed it. So if you really compare apples and apples where we are now, that 14.5 would be 10.5. So we're at 8.5 right now. Highest back then was 10.5. They had to hike rates to 21.3% in 81 to get that under control. And as we said, the inflation levels, they can only control the demand side. They cannot control the supply side. And so it's this view that the Fed is omnipotent and can control everything is just false. We know historically they cannot. And this is the conundrum, and that is why volatility is so high, because of this uncertainty of what can happen. So that is a problem, because if you look at it, the main components of it, the wages and the housing and so forth is extremely constrained. We're at 3.6% unemployment. There's 2 job openings for every job filled right now. So the demand out there is dramatic, and yet the supply side cannot fulfill that issue. Now it will be taken care of over time, but the near term is problematic.
Thanks. Don. You're muted, Don.
I think most analysts feel that basically the Fed was slow to respond here. And so there's some catch up going on, but most are sanguine that there's going to be an ability to level off inflation. And in fact, by many measures, you're already seeing inflationary pressures starting to notch down on the front end. I think the bigger worry is the markets in terms of the context of liquidity in the marketplaces, because you have several dynamics. You have the Fed with this huge portfolio and a need to liquidate, which is going to take liquidity out of the market. At the same time, that due to the ongoing regulatory nature has pulled capital availability by banks, investment banks and the like out of those markets. So I think people feel that the greater risk to markets right now is actually liquidity. And people are watching that very, very closely.
Thanks. Go ahead. Proceed.
So, Mr. Chairman, that was the end of the remarks of the outlook. I guess the final components that we just talked about was, this stagflation environment. We are in a stagflation environment where, GDP's last print was minus 1.4%, yet 8.5 CPI. It's looking worse in emerging markets and in Europe particularly. So those are issues that we are currently facing, and the outcome on that is very uncertain. The bottom line from what we're looking at is that the outlook that we've had over these years, we think the IFC had voted that we're on the right path and continue with what we're doing. And the one caveat that we've talked about is just stand ready that if we do have a situation where the markets do come off and we have an opportunity to increase our risk assets at a faster pace because of the valuation metrics are there, then we would need to call a special session and implement or ask for that opportunity at a short notice. And so that is kind of, we're standing ready and willing when the opportunity would present itself.
Patrick, I think what I hear you saying, and Mr. Treasurer, you can correct me if I'm wrong, is that the IFC is saying that the asset allocation we have in place is a solid one, and there is no reason to be sort of trying to play the market, so to speak, or try to take bets on things that are going to happen.
Mr. Chairman, the IFC had a general view of, yes, we're on the right path, but that defer there to Josh to go over the presentation that we had and talk about some of the concerns. So I think the biggest concern that I think that we had was just looking at the domestic for international stock, where we're overweight international, and I think that was one of the bigger conversations of what should we do on that part. But it was deferred to stay at the same. But the next part of our presentation would be Josh's asset allocation, going through all those various scenarios and the valuation attributes of that.
Fantastic, Josh.
Great. Thank you, Mr. Chairman. So I'm going to turn to the asset allocation review presentation. And page 2, just to give you the bottom line, which I think based on the comments so far. Just to recap, so as we do every year, we've updated our capital markets assumptions. These are our long-term forecasts of the next 10 to 15 years. Return, risk, intercorrelation amongst different asset classes. We met in March with the IFC to review those, as well as to update the formal study of your asset allocation targets. And the bottom line summary of that is to not make changes currently to the long-term strategic targets. But part of the reason for that is you made some significant changes, particularly last year, to those long-term strategic targets. As I noted, a significant reduction in traditional fixed income, which has been quite helpful already. But the other sort of offset to that is to continue to build out your private equity, private credit as a new investment category, private infrastructure as a new investment category. And those are markets that, to do them correctly, you want to build out vintage year diversification. So to not go and place all of that money at once, because quite frankly, even if you did, besides the risk of picking the wrong time to do that, you'd probably have some negative selection bias with managers that actually could invest that money today. That's going to continue to be a multi-year process. So we're going to continue to be on this journey. And I think I described it last year as we talked through the transition plan. It's like we've got this map for this long hike that we're going to go on. And over the past year, we at least wanted to drive to the trailhead. Like there were things that we could do to at least get to drive to the trailhead. So that's been achieved. And now we're just continuing on this journey that's been described. The other thing I would just note is, as you start to get closer and closer to sort of a true long-term portfolio, especially for the permanent funds, asset allocation changes aren't common every year. More commonly, it's something that you'd be doing about every 3 years, maybe every 3 to 5 years. So there's been more frequent change over the past several years as you've been building with the IFC's help towards more endowment-like investment portfolios, or at least as much as you're able to within your constraints. The probability that there will be annual changes going forward is likely smaller. So that's the bottom line. But I will, since we're not recommending changes, I do want to kind of just hit on some of the high points from our study this year, and then try to leave plenty of time for your questions and also discussion with the IFC members. So page 4, major themes for our 2022 capital markets assumptions. And it's funny, we wrote these like 4 months ago at this point, but they're still almost exactly what you just heard in the discussion. Inflation is almost always the most hotly debated number when we get together as consultants to debate these every year. We did raise our inflation assumption, but we raised it from 2 to 2.5. So still relatively low compared to what you're experiencing now. But we do think that this is transitory is the wrong word, but this is an inflation spike in what is still potentially and likely, from our perspective, a long-term deflationary cycle. There are some sort of powerful long-term deflationary drivers that we note here, things such as deficits, debt, demographics with aging populations, automation, technological advancement. These things all have the potential to be quite deflationary. Mean reversion. So this is just looking at, how did prices change in the last year? And keep in mind, last year we had a very good year for equities. They became more expensive. So for equities, that tended to cause us to lower those assumptions a little bit. You actually did see some bond yields rising last year. So you'll see for most of our fixed income, we actually raised those assumptions a little bit last year. I'm going to skip forward to just some of the summary pages of this. Page 13, this is looking at a lot of different asset classes, pretty much the full set. And I'd focus just on the right, the 1-year adjustments from 21 to 22. And if you look at the nominal return on a geometric basis, there you see, as I noted, at the top for equities, most of those lowered by about 0.25%. Keep in mind, these are long-term assumptions, so they shouldn't change very much on a 1-year basis based on 1 year of performance data. Typically 25 would be a normal move. 50 or more would be a pretty large move in these long-term assumptions. And you can see as you look at the fixed income numbers, as yields rose last year, we actually did increase some of those by quite a bit. And you can see the actual yield changes on page 14. This is something we do pay attention to, particularly for the income-focused funds, as those funds do still have a guaranteed 5% spend. And so it's important to, when you look at the asset allocation of those funds, understand what the sort of natural yield is likely to be from things like dividends, interest, rental income from real estate. Just a quick note on the peer data. I believe we may have actually presented this to you at one point already last fall, but this is looking back to the, every year we update this as of the fiscal year end, and we look at the asset allocation of other primarily U.S. Either severance tax, permanent funds, or land grant school funds. And this basically shows you the allocation to risk assets of these funds and how that stacks up. And for the Wyoming funds, and we've separated out PMTF from the Common School Fund. And for both, we're actually showing where you were at June 30 last year, which is off to the right-hand side of this page on the more conservative allocation levels. But the targets that you're moving towards and have made some significant progress towards since we issued this report are far to the left for Permanent Mineral Trust Fund and closer to the middle for the income focused funds, Common School, Permanent Land Fund. Now, obviously, the composition of risk assets is much different across the different funds. You have some states that have adopted a much more simple public equity, type of exposure. States such as Idaho, Arizona, Minnesota, but to the left, you can see more of an embrace of some of the alternative categories. Texas Permanent School Fund, New Mexico Severance Tax Fund, Alaska Permanent Fund, for example.
Josh, just on the color coding, the 5% on top, what is that? On the
Mr.
and PMTF.
Yeah, Mr. Chairman, that's private credit. So that's your new allocation to private credit, which actually is also a relatively new allocation for Alaska and for Utah. And I don't think it's showing up here, but I believe New Mexico is also adding that to their portfolio.
Okay, thank you.
So, Mr. Chairman, page 21 is the discussion of the differences between the total return focused funds and the income focused funds. From a long-term return need and primary mission of these funds, we would agree that their allocations should be similar. If that's where you stop, they have a 5% spending policy, an intergenerational equity goal over the long term. So there's, from that perspective, not much reason for the allocations of these funds to be different. The difference comes from the spending distribution rules and the constraints that places on these funds. The issue of only being able to distribute income is an issue for all of your permanent funds, but it's in degrees that vary. It's more acutely felt on the income focused funds with a guaranteed 5% spend level. And so this was something that we discussed with the IFC. It didn't result in a recommendation to change the strategic targets for either of the funds. You will see as we get into the allocation in both cases, you are going to be moving towards a point in the future where they are closer together. But this does sort of bring us back to this issue that I know Senate File 121 was intended to look at, and that is this constraint that you really have still on all of the portfolios from and its language that goes back to the 1890s of statehood, when Wyoming's Act of Admission gave the school funds to the state to support education, and the language that's still in there today that says only the income of which may be distributed. And it's that technical definition of income that sort of focuses in a modern investment context, sort of almost a little bit of a perverse focus on the wrong thing. relative to your objectives. So Mr. Chairman, I know it was something that you asked to look at. It was something that we discussed with the IFC. And I'll maybe pause there to see if you had any particular questions on that discussion or on this issue.
Yeah, thank you. My concern, and I think I was the person who made the recommendation for the income focus on the education funds. And it really was to that point. In a normal endowment or trust sort of situation, usually there are people who can make decisions based on, what kind of reinvestment you're going to make in the portfolio and how you handle capital gains and all that sort of stuff, something that Senator Perkins and I've talked about a lot. And I do wonder, in this case, it's almost the beneficiaries or the kids of the beneficiary kids of the trust who would be saying, how do we spend all the money that we make? And I, my concern has been if we just assume everything positive is income and spend it, and then when we have losses, we say, oh, well, that's part of the portfolio. We basically have established a one-way valve that drives our trust into the ground. So I was trying to figure out how to establish some discipline around that. Understand that the permanent mineral trust fund really has a very long-term objective, very different from, having to meet some of the. It is impossible for these trust funds to meet the burden for school funding. It's also impossible probably for them to meet the burden of doing that with generational equity. So just because inflation being what it is. So I guess I'm curious from the members of the IFC, how we do this as a normal trustee, you would say total return's the way to go. But if you're looking at beneficiaries who are perhaps retirement age, that was really sort of the construct I was trying to figure out, how we can keep discipline so that we can provide the income. But if we redefine capital gains to be sold at any time as income, but considered as corpus when there is a loss, that was the challenge I saw. So Tom, I know you and I've had this conversation. I didn't know if you had a thought on it.
No, Mr. Chairman, I think you actually stated it very well, and the constraints that sort of the endowment has. So I have nothing further to add.
Mr. Treasurer, any thoughts on that? I know you and I've talked about this as well.
I think that the structure that the RBK brought up that would be, would have been workable with some constraints, but I think there's a disagreement in the legislative process where the House didn't want to have very many constraints, and the Senate was a little bit more, I think, interested in putting some constitutional sideboards on. I think as that 121 left the House, it was almost like it was a new LSRA fund, because essentially with a vote of the legislature, you could get pretty deep into spending the fund that or the dollars that were available from any basic sale, unrealized capital gains included, to a certain extent, without any valve at all. Or most, I guess, states, Mr. Chairman, they have a constitutional provision of a certain percentage, somewhere between 4% and 5%, depending on the state. I think New Mexico had 5%. And that was in the Constitution. And at one time, they raised that 5% up with a constitutional amendment, fairly high bar. And it didn't take them very long to understand that over 5% was just way too high. And they dropped it back down with another constitutional amendment. But as it left the House, necessarily it did not need a constitutional amendment. And even the amendment in the Senate, I think, put a high voting standard as far as, I think it was 2/3, but still it didn't have the I think the protection that other states had in there. And it pretty much, I think, died from my perspective. And maybe Drew he was on the floor, he may be able to have, I guess, a clear understanding exactly what happened on that day. But it seems to me that if we're to get a total rate of return type of a endowment mechanism that's put forth, we're going to have something that changes it a lot more than what was there. And I think that Josh put forth, I think, some very good recommendations, and I tried to follow those, but I don't believe they were essentially adopted by either body. So it's as you all know, it's a work in progress when you do legislative work, and constitutional amendments are probably the hardest thing to do, because they have to be easy to understand by the public, and they have to be doing the right thing, because the public's pretty smart about those things. They don't let too many things get by them, especially in a constitutional amendment. So, Mr. Chairman, I think there's a lot of work to do. There's a lot of education to do. And there's a lot of, I think, that has to be done in the Constitution, because whether or not, we feel comfortable with the current legislative process, we all know that's going to change every year. So there's I don't know. Well, I guess I could say the path isn't clear, and it needs a lot of work.
Thank you, Mr. Treasurer. Don, I see your hand up.
Yes, Mr. Chairman, consistent with the treasurer's comments, I would make the following, and both in sovereign, but particularly where I see it in the endowment world, I think that there are a couple characteristics that are helpful to address this. From a realistic perspective, as you can see from Patrick's earlier comment about expected returns, generally speaking, institutions have been moving this down from a historic rate of 5-ish down to a 4-ish rate. But but two comments on that. One is more and more institutions and states are in effect codifying a range and then allowing a decision, whether it's by boards or by legislators, within that range. The second, so that deals with temporal issues. The other comment I would make, which has not been raised, is that virtually all of these are based on some form of rolling average of prior years. And some are 3, some are out to 5, in extremis, they're out to 7. But what that does is, for example, by taking the quarterly average for the last 5 years, it smooths significantly that calculation. So it avoids some of the issues in budgetary times of sharp ups and downs, because often that's more problematic. It's the sudden, it's like the old saying, it's not the fall that hurts, it's a sudden stop. And that type of mechanism, I think, offers some opportunity to address these issues we're contemplating here.
Yeah, and Don, thank you. And that, we spent quite a bit of time in years past really talking about those various formulations. And, a 7-year can quite easily keep you underspending when times are good and overspending when times aren't so good. So, there's some weighting principles and so on. And I think we do have those built into our policy now. The trouble is that all the mechanisms we've done to protect that ability are things that are getting rated by the legislature on a regular basis. They put in our spending policy reserves all kinds of holes to, suck funds off before they can go in. And that's a challenge I think we have. But Josh, I guess having RVK was sort of the architect of those originally when we were up in the 7.5 range back in 2002, and then gradually rolled them down to where we had this sort of rolling, which was around 4. And I think routinely we've passed somewhere between 4, but nobody can stop spending at 5. So, and I guess what I'm particularly interested in is there a formula that we can put in place and somehow safeguard it? And then, I don't know if it's this board, which is, I think, probably where it might reside, but that there is some ability to staunch overspending somehow, because if we can establish like a true endowment model, not something where the kids are deciding how much money they should get, then I think we have a really good formulation going forward.
Yeah, Mr. Chairman, the distribution rules are contained within statute, but also the Constitution and the Act of Admission. And unfortunately, the best solutions, it's not really a mystery from our perspective what the best solutions are, but the best solutions require changes to all 3 of those documents. And those, as I've learned, those are not easy documents to change. There are potentially some things around the, absent the removal of the income language that affects all of the funds. There is some potential, I think, around how you treat your reserve funds that could be more helpful in this environment, and how those reserve funds are invested, because the way that it's set up now is you have really a pretty small reserve fund relative to some of the other funds that have the same sort of mechanism in place. And because it's small, and because it may all be needed within a relatively short period of time, next 2 to 3 years, for example, it's very conservatively invested. So one of the ways we've seen some other states address this is larger reserves, but because they're larger, allow them to be invested sort of pari passu with the corpus portfolio. That would be one possible way to move in the right direction, I think, with some of this. But I would caution that is still, you're still in this modified sort of total return space that's modified. You still don't have a true endowment model where you've got a sustainable spending rule based on all of the factors that Don was just talking about, and you're indifferent as to whether that's, what the accounting sort of definition of the dollars are. You even with these, I've talked to the CIOs at these other states with larger reserves, and they worry still about, the scenario where markets crash, they don't recover quickly enough that even with a larger reserve, you could still find yourself in a troubling spot. It would take something much more severe to do that, but not impossible. So, Mr. Chairman, those, I think there are some things you could consider that would be helpful, but ultimately the best solutions do require being able to move beyond this sort of income definition as describing not just what you can spend, but requiring that you spend all of it.
Okay. Dick,
Thank you, Mr. Chairman. I want to first say I agree with everything that Don and Tom and you have been saying. What I want to add is what I see is I understand the income only policy had good intentions, protecting the corpus and all that, but there's a danger to it that I see. Suppose there's a severe collapse of the economy, but you need, like you were saying, Wyoming still needs to pay its obligations, pay people's salaries, et cetera. It has spending needs. So you look at the portfolio, where are you going to get the money to continue to spend the money needed to run the state? Well, a certain percentage of the portfolio may be in illiquid private securities, so you can't sell those. And then another group in the portfolio is in stocks or other securities that in that scenario might be sitting on unrealized losses. So you can't sell those because you'd be realizing the losses, and that would reduce your income. So then you look further down into the portfolio, what are you going to sell to meet the spending obligations? You sell the bonds. Okay, you start selling the bonds, suddenly now you have less income because the bonds are what produce income. And so in this perverse way, in a severe market pullback, you hurt the state's ability to fund itself to meet the obligations. And that's a fatal flaw in the income only scenario. That's why a total return approach, where you don't keep track of the corpus or the income, you just look at the total returns of the portfolio averaged over 3 to 5 years and develop a stable, dependable, forecastable spending policy based on that. And that's the best way to go.
thanks, Dick. So the question that I wanted to address, I think you put squarely on the table, which is there's obviously complication in trying to run different asset allocations and move and do all of that. Does it make sense, or is there a reason? Because I think the recommendations are stay the course, but does it make sense to just jettison the income only approach and align permanent mineral trust fund with common school, which is what we've done traditionally well before I made the change? And would that be more simple? And then we can get on with it.
Yeah, Mr. Chairman.
Yes,
Yeah,
Treasurer.
and I think that we're with the I guess the evolution of our PMTF, and where we're moving into a lot of different assets and a lot more diversity. I think that's going to provide us opportunity in a lot of those assets, to especially bank loans and private credit, to get I think another stable source of income, and even real estate to a certain extent where it spins off rental income, and we can structure some different assets in the future. I think in that regard, I think there's a way to get that diversified portfolio that can be that all-weather portfolio and spin it off. And I don't think it's going to take a long time to get there, but I think that over the course of the next 2 to 3 years, I think that we can move those things closer and closer together to where you're going to have at some point in time, you'll be able to almost flip the switch, and you'll probably have $15 billion that's almost invested exactly alike, or if not totally alike, in a period of time. But I think that we want to make sure that we do it in a measured process, because I think the reason why you went to the income focus was because of some of these different new types of diversifiers we put in, but we didn't have enough diversifiers in there. So if one went sideways, it didn't adversely affect the returns and the income. So I think that once we get to that all-weather portfolio and do it in a measured way, which we're doing now over the next 2 to 3 years, I think that we can move both those portfolios and frankly, all of our permanent funds closer and closer together. But it's something that I don't want to have, I guess, portfolio shock if we just snap our fingers and just rush to there and then try to figure out how we're going to balance everything out. And when, as I think Josh and several people said, some of the privates are necessarily, they're not that fungible, and they're hard to trade and hard to do different things, but they give you a great diversifier and great income. So there's some methodologies that we can move forward on. But at the end of the day, if we're going to have that stable, adequate funding, I think that we're going to have to put in that cap, those caps, as Don said, I think in the Constitution, but have the caps, and that way things won't get out of control. Because if we don't have those sideboards, you're going to continue to get diversions of what would be necessarily funds that you'd want to have in reserves to carry us through the rough times, and those structures, because those things get diverted. They get put in other priorities that are necessarily not the priorities of the fund, or perhaps it's the call of the day. And those are the things that I think we need to have that constitutional protections on in the long run. Thank you, Mr. Chairman.
Yep.
Mr. Chairman, maybe a couple numbers will be helpful for this. So as I think about this issue, I think about long-term returns versus current yield. And keep in mind, these numbers are a little stale at this point. They're effectively the beginning of this year, but our long-term expected return for the targets that you've got in your policies for these two funds it's 25 basis points higher for the permanent mineral trust fund. It's about 6 versus 5 3/4. So that may not sound like a lot, but we know that 25 basis points a year over 10 to 15 years, that adds up to real money. So we would prefer to have the higher return, obviously. The yield numbers, though, are what you have to pay attention to for the school funds. And it's 100 basis points higher yield for the school funds. It's about 3.5 versus 2.5. Now, 2.5 is just fine for PMTF, but if we dropped the school funds from 3.5 down to 2.5, it's just moving you farther away from what's been guaranteed to fund that spending policy. So those are hopefully helpful numbers, because that's really kind of where the crux of this issue lies.
And Josh, that's exactly the point I wanted to get to. So, Patrick.
Yes, Mr. Chairman. The other point I did want to bring up is the legislature is very aware of this, and the Subcommittee on Capital Finance has 2 different meetings throughout the year, 2 full days back to back, to discuss some of these comments or considerations. And one of the big things, obviously, is the spending policy. And if we had a higher spending policy, then that would negate some of the need to have the income where we'd have those years of spend that would fulfill that. So I know that is an issue that they wanted to discuss. And the treasurer and capital finance in our group, we've discussed this in depth about potential ways to mitigate some of those concerns without the change in the Constitution. And those will be discussed throughout the year.
And I appreciate that. I think, and Honor, I don't know if you've got a question, but there are obviously constitutional and active admission constraints that are anybody's guess how they come out. When we put forward Amendment A, as you know, I worked my tail off to get that thing passed. 51% of the voters that day. And it's really tough to get that done. So you never know exactly what's going to happen. And I'm fully down to try to make it both that and then, going to Congress and figuring out whatever they're going to do. I know some states have been able to amend their active admission, and that could be fun too, but never have done that. What I am particularly interested, though, because we can affect the legislature and legislation and trying to figure out if there are things, we have a spending policy reserve account, but maybe it should be called an earnings reserve. And maybe we should consolidate our some sort of a buffer fund and be able to defend that, the way we are doing the LSRA. And then to the Treasurer's good point, which I think is where you sort of started on this, Mr. Treasurer, was let's make that a constitutional fund, which has limitations on how it can be deployed. So I think those were the things I wanted to really fully join as we went to the legislature. But what I think I hear you saying is that, in fact, everybody feels pretty good about the current course of action. My point was both funds sort of started in the same place. They've moved marginally off of where they've been in these two different trajectories, but they can be realigned relatively quickly and probably easier now than they would be 3 years from now. Well, I hear a resounding conversation on this.
Mr. Chairman, one thing that I'm thinking of here is, in the past couple of years, as yields have moved lower and lower, it has forced a little bit more difference between these funds. If the natural level of yields increases to where it doesn't take 100 basis point yield difference for the school fund to meet its distribution requirements, it would be easier at higher yield levels overall to have these two have the same asset allocation.
Okay.
8% 30-year bond. There we go.
Okay. All right. Well, I think it should be a topic that we continue to explore. And if the legislature is doing it, perhaps we can be part of that conversation.
Absolutely.
So, thank you.
Thank you, Mr. Chairman. I'm going to jump ahead to page 28, just to I think there's a good sort of picture in here of where you've been, where you are now, and where you're trying to get to. And this is the efficient frontier analysis for the total return focused funds. And you can see the green square is where you were a couple of years ago, prior to the changes you made last year. The orange square is the long-term targets that you approved last year. So you can see the pretty significant move up the risk curve, higher return with higher risk, but very appropriate for the time horizon of these funds. You can see how poorly Global 70/30 stacks up. Now it's done very well, obviously, over the past decade, but as Patrick noted, is not priced to deliver stellar returns over the next decade. And then the important note here is the blue square. That's the interim targets that you were pretty close to in all of your funds at March 31st of this year. And so you can kind of get a sense for the progress you've made, and you have made some progress over the past year. You've essentially, as I described it, driven to the trailhead at least. And it's going to be a little bit of a slower process over the next several years to build out from the interim target to the long-term target. And that's because if you go back a page and you focus on the blue versus the orange, the interim versus the long-term, the areas that we still need to work towards are pretty much all in the private markets. So we still need to get from 8 to 11% in private equity. And we'll continue to work on that with the pacing and manager commitments. Still working to get from 0 to 5 in private credit. You just approved the first manager there, and I believe we'll see another one this year. increasing non-core real estate by 2%, and also increasing private infrastructure but from 0 to 2%. You do see hedge funds also going up 2%, and that's actually one that we do. That one won't take as long. The roadmap has us getting from 7.5 to 9.5 by the end of I believe it's September 1st of this year. That one will not take quite so long. Where is the overweight residing today? Well, for the 3% in private equity, that still resides in public equities. So you do have that in the equity category. The private credit, real estate, and hedge fund and infrastructure underweights are housed in a couple different places. You added this low duration fixed income, this transitional lower duration fixed income account that's currently at about 6%. And if you go look to the 2020 target, which is where you were effectively a year ago, you were at 25% ag fixed income. You've lowered that to 13.5. So you took a big chunk out of that and moved not all of it, but some of it, and in fact, a decent portion of it, to this lower duration transition account. Now, that lower duration transition account wasn't immune from losses in the first quarter, but it was down about 90 basis points, and the ag was down about 6%. So that transition strategy has so far served you relatively well. The other overweights, you can see bank loans remain a little bit overweight, and as we fund private credit, will likely that will be a logical source of liquidity for some of that, and also still a little bit in core fixed income, still working down towards an 11% target there. So that gives you a sense for where you were, where you're trying to get to, where we're at today for the permanent mineral trust fund. And I don't know that it's necessary to walk through all of the funds, but the other one that I would highlight for you is on page 33. This is just looking at the income focused funds. And you can see the same thing here with where we were, where we're working towards. You're actually a little bit closer on the progress path here. That's because these funds don't have private equity in them. So there's less of a need to build that up. We did also plot for you here the permanent mineral trust fund long-term targets, just so you can sort of see on this efficient frontier where one is versus the other. And you can sort of see as we've, for these funds, logged the also below the expected sort of natural yield on each of these portfolios. So you can sort of see those numbers I was talking about. You know, long-term expected return is about 25 basis points lower, but the yield gap is still about 100 basis points. Now, as we come back to this next year, you know, yields might be high enough that you could consider maybe moving these closer together, if not pari passu. So, Mr. Chairman, I hope the rest of this deck has the same type of information for all of the funds. But again, the recommendation is not to change the strategic targets, but that doesn't mean not doing anything. We've actually still got quite a bit of work in front of us to build to these targets that have been approved. And, you know, as market conditions change, you know, that could potentially either speed up or slow down that progress. You know, for example, if you saw a big dislocation in the market, that might be the kind of opportunity that allowed you to maybe take a bigger bite out of moving towards these targets after that's happened. But, you know, absent that, we recommend just continued diligence and following the pacing plan because these things are very hard to time in the short term.
Thank you. Any questions? Any comments? Well, thank you. I think obviously we don't have a vote to take today. We'll do that in June. Is that correct?
That's my understanding, Mr. Chairman.
Okay. Is there any other, I guess, as you look at the challenges on the LISRA in particular and Amendment A, do we want to just take a quick moment to talk about those? Pool A, I guess.
Yes, Mr. Chairman. So Pool A, you can see on page 38 is the same analysis with the long-term target. Now there is a much smaller degree of change happening with Pool A relative to the other funds. It still remains a moderate but still diversified portfolio. The big change here you can see on page 37 was going from 49% in aggregate bonds to 30%. You have actually made most of that change already, bringing that down to 32.5%. You do have 11.5% of the fund here sitting in that transition low duration account. As you look to build out, particularly core real estate, that's going from 4 to 10% in Pool A.
And so, Patrick, go ahead if you've got a.
Just one quick comment. When you look at the interim target where it's spot on the 2020 target, that's primarily just with private credit and infrastructure as well, which it's not that we haven't done anything on it. It's just that, as you know, with the pacing schedule and so forth,
Right.
that will take time over the next couple of years as we build out that part.
Well, and Patrick, I know you know, and some of this Pool A money is also responsible for operating capital for the agencies. There's hopefully a little better return, but they're much more exposed to volatility than the PMTF. And I didn't know if the IFC was aware of that, and there's one reason I wanted to mention that.
Mr. Chairman,
Yes.
Lisa Judy Spillman, General Counsel for the
Yes,
State Treasurer's
Lisa.
Office. I just wanted to let you know, last year and in previous years, the board has had a board matter that they did vote with respect to approval of the asset allocation. There is no change this year. We're just recommending to stay the course. We did write the board matter for approval of that. It doesn't have to happen that way since there are no changes, but that is historically what we've done. We've accepted your approval and then we incorporate that approval into the IPS when we run it for your approval in June.
Right. Thank you, Lisa. So Josh or Patrick or anyone, do you foresee agencies coming and saying, gosh, I thought we had a certain amount of money and now we've taken losses in the stock market and that's going to affect our ability to run our operation?
Mr. Chairman, I have, it's been probably over a year since I have spoken with any of the agencies on that. As you know, the legislature kind of dictates on who's in and who's out.
Right.
So they don't really have a say-so on it. But if it's something that the board would care to do and Treasurer would want me to do that, I'd be more than happy to reach out to the various agencies to double check on those spending needs.
Yeah, and I think my only concern here is if there is volatility in what they, because when they get a budget, they think that's what they're going to have. But if the market corrects and there's a big sell-off, there isn't really a reserve capacity on this fund, to my knowledge, is there? Except for the LISRA in some cases.
I believe so, Mr. Chairman.
Yeah.
But the other component on that is, just as we talked about before, their need for the spend potentially could be even at a greater need than what we have in the PMTF and so forth. I'm talking about the constitutional amendment part of it,
Right.
to where they look at this fund saying all of the income that they need, that they have more spending requirements. And as we know, with the lower interest income and so forth, it can really dampen these type of funds, as low rates have really hurt
Right.
them. Pool A would be a prime poster child for why we need to change. Another reason for the constitutional amendment to just be able to allow these funds to spend the income, because if it's only you could have a 20% total return, but if 1% is in interest income, dividends, and realized gains, then they can only spend 1%. And many of them, as you know, do not realize that, and they say, no, you can only spend this portion, which is really problematic for many of them.
Yeah. But Josh, to that point, Pool A, you believe, is properly configured with an asset allocation?
Mr. Chairman, that is correct. We don't recommend any changes to Pool A other than to continue making progress on the changes to build out some of the additional diversification.
Okay.
Pool A is in a little bit of a interesting spot. As you've been describing, it has some beneficiaries that rely on the income from these funds as well. And some of those funds may also have a longer term return need. So it is trying to solve for a lot of different things in one structure. So you're balancing quite a few different things with Pool A, but it does seem to strike a pretty appropriate balance between those factors.
Yeah. Okay. Any comments from the IFC? Just wanted to raise that issue, and I think actually, in my view, being legislative funds for the most part, those probably can be dealt with legislative fixes on definitions. My sense would be.
And Mr. Chairman, just to highlight that concern, you're spot on raising up that issue. But with some of the asset allocation changes, I just do want to highlight that with what we're talking about, going from the interim targets, when you add those infrastructures and private credit funds, they have a much higher, you're giving up a bit of liquidity, which they don't need, but the yield alone will help. So if you can see the difference on the long-term target, which is a 286 versus a 249, they will be receiving more income as we implement some of these changes. So that is that would be positive for their cash flow needs.
Thanks. And then finally, LISRA.
Mr. Chairman, I'd point you to page 47 for LISRA. And the key to the LISRA structure is that you have these three buckets, and it's really sort of layers of liquidity. You've got a short-term reserve, which is 100% in short-term and high-quality fixed income. You've got an intermediate term reserve, which is 100% in intermediate term, high-quality fixed income. And then you've got a long-term reserve, which is diversified across equities and alternatives. As I noted, it was sort of interesting in the first quarter that the worst performer was the intermediate reserve, because that's what got hit the hardest. And actually, your best performer was the long-term reserve, even though it has the most risk asset exposure, but it's diversified risk asset exposure. So you've got some things in there that actually did quite well in the quarter. But the key, though, to the LISRA from our perspective, and you actually approved some language in the policy mid-year last year that cleared up the ability of the Treasurer's office to allocate and control the dollar amounts that are in each of these three buckets. I believe the statute requires at least 500 million in the short-term reserve. But prior to the change you approved last year, it wasn't clear that they could have more than 500 million in the short-term reserve. And based on the projected liquidity needs, it made sense to have more in the short-term reserve. So that policy change you made last year actually provided quite a bit of appropriate flexibility to really engage in treasury management, which is, having the right amount at the right risk profile within the LISRA.
Very good. Well, thanks. And any further comments? Mr. Treasurer, any questions, members of the board?
Well, Mr. Chairman, we're just going to stay the course.
From the IFC, and Doug, it's good to see you. We didn't see you earlier, so welcome. Thanks for your work, and Cecilia also as well. Thanks for taking some of the morning to kind of go through this. Very much appreciated. Ken, also good to see you. Oh, and there's Drew and Russell. Great. Drew, or I should say, Senator, any other comments?
No, not really, Mr. Governor. And I've been called a lot worse things than Drew, but anyway, the only thing I would just bring up is just to correct one thing on Pool A, and that is that while the legislature approves who's in and out of Pool A, we're very careful. We don't put anybody in Pool A that hasn't requested that they be put in Pool A, and we try to make sure that they understand that when they invest, that there's not, not only do they have the potential to have gains, but they also have the potential to have losses. So that while it is the legislative approval, it does take legislative approval. It doesn't happen without consultation and actually the urgence and the request of the involved agency. Anyway, that's all I just want to correct that. Thank you, Governor.
Thanks. All right, anything more? All right, what an efficient morning. Thank you. Well, thanks very much. Thanks for being on the call. Sam, it's good to see you. Any particular perspective I didn't call on you, any particular thing you would like to add?
No, great conversation. A lot of good points made. And I think the income and the income discussion will be very interesting. I think it's important to get a fix there that will allow for some flexibility, but also prevent any excess spending. So yeah, looking forward to working on that.
All right. Thanks, Tom.
Thank you. Mr. Chair, I may make one sort of parting comment. One of the things for those folks that it may seem a little odd that maybe we didn't do anything on the asset allocation. And one of the things with asset allocation is best practices really say you make changes every 3 years, 3 to 5 years. And so I think that frankly, it was good discipline of this group to, not try to make change for change's sake. And so I just think it's important for the Slib members to understand that, and that, it is such a sort of long-term horizon investment focus that it's just important not to try to really make changes every year. So I just wanted to say that, Mr. Chair.
Thanks, Tom.
Yeah, Mr. Chairman, I guess comment is that the retirement system kind of has that dual mandate of providing both long-term 30-year returns and also they've got a lot of money going out too, so they got to generate income too. So they kind of have a dual mandate. So I think as we look at going forward, developing our all-weather portfolio, that we kind of pay attention a little bit perhaps to what WRS is doing. We might gain some insights in different ways there.
Good point, and that's why Sam's on here as well. So excellent conversation. I don't know, Ken or Dick or Don or Celia or Doug, if there are any comments you'd like to make.
Mr. Governor, if I could, it's and my colleagues on the committee have this. I'm going to sound like a broken record here, but just to remind everybody, if we took the state's roughly $25 billion and put it into a conventional endowment fund, like a lot of universities or some sovereign wealth funds have, and we invested it, and we said to ourselves, we're gonna authorize a 3.5% annual draw. Well, you'd be drawing $875 million a year for whatever use the government beneficiaries wanted it to be used for. The history is that you would not only preserve the value of that fund, but it would increase over time somewhat. And I always think to myself, if we're having a conversation I call that the starting from scratch discussion, because in some respects, if we're thinking about the long-term public interest, it's worth keeping that in mind, because so much of the specifics of the asset of the various pools and everything is in some respects a legacy. It's a relic of a long history, and I think best practice has evolved so dramatically over the past, particularly the past 25 or 30 years, that it's kind of worth thinking about that. I'm also very conscious of the politics and of the public relations involved in making moves in that direction. But I also think there are examples elsewhere in which public sector sponsors have been able to carry that off. So I would just make that point. It's not, it relates more to the earlier part of the discussion. But I try to keep this in mind because I think it provides sort of a long-term target, if you can call it that, for best value for the public.
Thanks. Oh, and I was going to call on Russell. I forgot him, but he dropped off. So
No, I'm here, Mr. Chairman.
You're there. You're there. Yeah, go ahead.
So I concur with my fellow IFC members, and really wanted to point out that we had made a substantive set of changes last year toward diversifying the investments, particularly across the private asset classes. That's kind of something that pays off at a time like this. So we are, we have instituted kind of an important diversifying change. One that was pointed out is intended to provide some compelling structural income, on some of the classes and some good long-term gains, but across the board, trying to reduce sort of the market volatility that you get if you just had, particularly, a stock and bond portfolio. So I'm pretty happy with what that, with the direction of the portfolio, and I think it's it's going to be it's a multi-year process, but I think the team has been responsive, and the portfolio is showing benefits from it.
Thanks, Russell. One thing, if you have some perspective, oftentimes people look at Alaska Permanent and then make comparisons, but it's sort of awkward to do that because they're really different in their purpose. But the perspective I was hoping you might be able to give us is, what the capacities of the treasurer, because, the treasurer also has a portfolio and I think serves on maybe the retirement board in Alaska. Alaska Permanent really sort of set up differently, but the reserve account, if I remember correctly, went through several $1 billion before the legislature finally understood they couldn't just spend it off. So I don't want to put you on the spot, but I thought if you could take just a moment just to give us a perspective on how Alaska dealt with adversity.
Sure. I'm a good person to ask because I am no longer in Alaska state government. And so I have, you're exactly right, that we sort of had in Alaska, we had a pretty big structural deficit that was filled by a reserve fund. It would be mortifying if I were to tell you how large that reserve fund was. Let's just say it was over $10 billion, and it was gone in a relatively short period of time. So it was I think these the structural spending issues in Alaska were sort of extreme. So there was a fairly big reckoning. But on the other hand, we had an $80 billion permanent fund. But it was not lost on us that without imposing that sort of, kind of the discussion that we're having now, without imposing a discipline of being like a sovereign endowment fund, you could lose, you could sort of lose your perspective. Even before the permanent fund was raised at all, which was in 1977. The reason why it was formed is that there were windfalls, tremendous windfalls from 1969 through 1976. And the state spent every penny of the windfall. They actually saved none of it. And so the state's reckoning at that point was, if we don't impose fiscal discipline that's appropriate, we will just continue to spend every penny that comes into the state. So it was, I think the lesson of Alaska is one where you can be well endowed, but despite how well endowed you are, your fiscal situation has to be, your fiscal spending has to match. And in that sense, Wyoming, from what I see, is actually been systematically more disciplined and more thoughtful.
Well, thanks. Well, great. Thanks, Lisa, Patrick, Josh, any further comment?
Yes, Mr. Chairman, I did want to bring something up. Just the treasurer and I have had discussions, and he was bringing up the potential of some of the things that we do on our internal trading. And one thing that I just wanted to kind of reiterate, and the treasurer and I have had conversations about this, and also the IFC. But when we are looking at the active investments of what we're looking at, when we're taking an active discussion in what we're investing in. And what we do right now is, you might see if we're supposed to have $100 in fixed income, we'll show $100 in fixed income, but our duration might be half year short, or in private equity, we don't have any VC, so we're like 11% underweight that. We're short equities right now, but we don't do it in a meaningful way to where the return to the portfolio could be in a 5% or 10% difference. And I think, Matt Clark, I think it's Clark from South Dakota is kind of someone who has done that in a much more meaningful way. And so the treasurer and I, we've talked about this, and I just thought before we end today, kind of looking at it in what is, the board and the IFC, is that something that we should be looking at to take a more meaningful active bet? Because if that's the case, then I really feel that to do it properly, we need to have all tools in the toolbox. We need to have We need to have the ability to go long and short. We need to use leverage. We have to be able to use futures and derivatives and options. Similar to WRS has that toolbox, and yet we don't. And so if we're going to do it, to be long or less long is not the optimal way. And so we've talked about it before, but that is something that I think needs to be more codified or clarified. What is the IFC and the board's decision to do so?
Interesting discussion. Mr. Treasurer, any thoughts on?
Mr. Chairman, and I think it's a discussion that probably needs to have a lot of information on it, and that's some of those topics I think we're planning on bringing up in our Treasurer'S conference, looking at different things that other people do. One of the things that WRS does is that they don't have a 5% opportunity bucket, but they allow the staff to make, some reasonable bets or reasonable areas where they differ a little bit from the benchmark. And so they take their opportunity within each asset class rather than coming in and having a separate defined opportunity like we did with Instacart, for example. But I think that, the other ways that people look at and the other ways that people invest. We want to bring forward some experts from different areas. One area is in venture capital. One area is in people like Matt Clark that take different sizes or different kinds of positions in a market for different reasons and different identifiers and different factors. Other people that do sector rotations as far as in and out of sectors from time to time. You can have a market that may vary 5%, but within that total market, you may have a sector that's up 30 or 40% or down 30 or 40%. And so looking at those different areas where you can keep your risk, relatively the same as far as the overall risk, but looking at whether or not you make measured decisions on which way you go and how people have done that, how people have either been successful or how people have failed. And so that's one of the things that I want to kind of bring up during the conference is the different types of ways that people invest, understanding that it may be all well and good and they do a great job for it. But in a lot of circumstances, like South Dakota, they have, I think, 17 professionals just on equities. And that means, something, an extreme build out that we neither have, I think, the money or the time for, but it'd be interesting to see, how successful that they have been in different areas because South Dakota has been very successful. So just kind of looking at the different opportunities that people have out there and just generally giving a good education, I think, to both the board and a good discussion, hopefully, in that regard.
Okay, Sam, can you, and Don, I'll get to you. I just wanted to ask Sam a quick question. Sam, when I was doing time on the retirement board, you didn't have an internal portfolio you were running. It was primarily taking bets a bit on particular sectors. Is that correct? You're not sort of going out and taking shots on particular stocks.
Yeah, Mr. Chairman, that's correct. So we have the ability to make tactical trades, which are typically very focused on certain mispricing, and we do anywhere between 0 to 2 a year. And typically we do that with futures. And one clarification I wanted to make was that we have the ability to use futures, which we use through a third party. But when we do, they're always 100% collateralized with cash. So we don't use leverage and we don't use options either. But we don't have anything similar to Treasury in terms of internal trading.
Yeah. Okay. Don, go ahead.
Yeah, I just want to make a couple points on the whole internal notion from the treasurer's comments as well as Sam's. No one raises this, but if we're going to do this type of thing, you have to have a robust administrative operations back office, which we do not have. And so I would just remind people that if this is an intent, we have a significant task there. Secondly, it's very dependent upon the quality of the people that you can draw in. And we should ask the question if we have a competitive advantage, or alternatively, as the retirement system does, and as Sam has indicated, you can use something such as futures and you can use third parties to take those particular positions. So there's definitely work to do here, but I want people to be careful not to leap to say, well, what we're going to do is have someone, buying and selling and long and short equities to take a position. I think we are a very long ways from there.
Yeah.
Mr. Chair.
Tom.
Yeah, thank you. No, just to add to this, I mean, again, we've done a tremendous amount of work looking at various plans. I mean, South Dakota, they spend about 5 times the amount on their staff that we do, certainly from the pension side, and obviously from the Treasury side, it's even a bigger multiple. Wisconsin is another one that does a almost majority internal trading. And again, they're at about 5 times what we spend. And then even if you take the Canadian funds themselves, those numbers are almost 15 times, right? But they're also doing private equity transactions on their own. So they're the most, quote, further on the curve than anybody. But I just wanted to add that to really basically agree with Don's point that, what you need to do if you're going to do this right, you've got to add tremendous amount of resources.
Yeah, thanks, Tom. Well, I think it's probably a good conversation to have. My sense is that we've been always very conservative in our posture, and that's sort of a tradition here. But if the investment funds committee wants to sort of examine a little bit more what the capacities are, because you can look at Wisconsin, you can look at South Dakota, you can also look at Idaho, which basically under Don basically just sort of said, we're going to put it all passive in Vanguard, and they did pretty darn well too. So very, very interesting.
Yeah, Mr. Chairman, I think the overlay that WRS has, that's probably something that wouldn't take a lot of I guess extra people. It's contracted out, and it allows you to be pretty much right on your benchmark. So those, there's just some different tools that the retirement system has, and just kind of just give hopefully an opportunity for everybody to take a look at some of these things, and certainly agree with both Don and Tom that some of these different ways that people invest, may not now or ever be something part of the investment protocols that we have here. But wanted to take a look and see how other people do it, and how the possibilities that are out there. It's more of a future look rather than we're going to implement this right away look, guys. So
yeah. Tom, what was, I can remember, and not to bring up sort of skeletons. Oh, I have Cecilia, go ahead.
Just,
I think
my only comment is this has been a great discussion, but I think there's been a lot of discussion about the problems and the recession potential and negative opportunities. But I think there's some really excellent opportunities that have come from the drawdown that the markets had, and the change in the asset allocation that's happened over the last couple of years, and the buckets that are still to be filled. And there's some amazing managers out there who are open now, raising funds for private equity, private credit, VC, and we've got room to do it. So I think that 2022 could be a really wonderful year of sorting out, forget the sort of made here activities, which we just talked about, but just in excellent existing managers with excellent track records over many vintages. I think it could be a very exciting year for deploying capital.
Good point. Very good point. Tom, I was trying to remember, just to sort of put in perspective, that there are bets that sometimes are, one does, and not to bring up any sort of skeletons. I'm trying to remember, we had a challenge with the retirement fund a few years ago, and Sam, don't take offense, you managed incredibly well. I'm just trying to remember, it wasn't long-term capital management. Who was it? It was.
You mean Pershing Square?
Pershing Square, that's the one. Yeah.
No, that's always a fun one to sort of poke Sam with over the years. But to be honest, though, again,
I'm not meaning to poke Sam, because I think
no, not at all. I mean, I think that, though, that one actually, though, again, sort of time heals wounds, and has actually turned out to be a reasonable investment. We're still lagging the S&P on that particular investment, but at the same time, we've been able to take money off the table, and it's actually turned out to be okay. But I think the initial drop was what was a bit painful.
Yeah.
To say the least. But I will say one thing. I think what Sam and the team have done really well is, we have 5% bands effectively around each asset class. So they do have room to sort of take positions, but it's very, very rare, frankly, that they do. And they do that. And as the treasurer indicated, the overlay system really is a great mechanism for the rebalance capabilities, but it's also a really great mechanism to when the team can kind of create sort of these tilts. But I would argue they do it very infrequently and with extreme caution, because I think, again, we, like so many other, I think, institutions our size, don't have necessarily the deepest resources. And I think we're pretty honest about that. But, overall, it's been a success and sort of used very cautiously.
Yeah. Well, very good. So further conversation. Sam, you had something.
Yeah, Mr. Chairman. Yeah, just a little more color on Pershing. Yeah, that was definitely the most painful investment we've had over the last 10 years. And I think we bought it right before a major downturn, but since then it's performed very well. And I think net we're behind the S&P about 1.5 or 2% on that. So despite being a bad investment overall, it's worked out okay.
And Sam, I wasn't meaning to characterize it any other way. I just the point is that sometimes things, and you have to have a long hold on them. So anyway,
Mr. Chairman, just real quick, Cecilia, great comments. I'll probably be giving you a call. And maybe we'll get you with Matt Schmagosh and Patrick. They're always looking for bright new stars. Thank you.
Mr. Chairman?
Yes.
Lisa Jurdy Spillman, General Counsel, State
Right.
Treasurer's Office. I can just make one comment about this conversation that we've been having about derivatives and the internal team. So as this board knows, the legislature says that the State Treasurer's Office can invest the way the legislature says it can, or it can invest the way Slib says it can. And the way Slib says it can is through this investment policy. Back when we created the internal and external team, we added the name internal management team alongside investment managers. So the investment managers do have the authority to invest in derivatives based on the policy. There are places that they can do that. We've never prohibited the internal investment team from doing that in the policy. They would have to abide the policy. I understand it's the policy is absolutely no leverage, both for internal or external managers. But I believe it's been our office's internal policy not to do any of that until we had further guidance and more, bounds on that, hence this conversation. But I just bring that up because that's the way the IPS is written now. It does not distinguish between those two.
Yeah, and it's been a while, Lisa, since I remember that, because when I came on, of course, we were in right after 2008, and very strong anti-derivative language. In fact, I think we had to make some exceptions for derivatives on particular managers just for that reason. And I don't remember taking out the derivative language at any point. I don't know. I'd have to go back and look at it, but
there is derivative language still in there that says that you may use derivatives as provided in this, in this section.
right. Okay.
Well,
And
Mr. Chairman.
let me get Josh and then you, Mr. Treasurer.
Okay.
Yeah, Mr. Chairman, the primary issue, because we've looked at this, overlay programs, I would agree can be very beneficial from a rebalancing perspective. The primary issue that you have with it is the fact that these are relatively short-term contracts that can expire at a loss, and you have little control over that. And so it's, again, we're back to this income discussion. Yeah.
Well, and I remember, lots of conversation about that, but go ahead, Mr. Treasurer.
Yeah, Mr. Chairman, as far as leverage, that has to do with the benchmark, I'm assuming, Lisa, because there's leverage in the Odyssey and in a real estate think it's around 23, 27%. It's somewhere in that range. So say that we can't have any leverage, I think that's not quite accurate.
Excuse me, yeah, Mr. Treasurer, Mr. Chairman, this was specifically related to separate account situations as opposed to alts, in which case the SLIB would have approved the material terms and would understand the leverage
Right.
component.
Yep. Okay. Well, further conversation. Let's find out if we can put a bunch of puts out there and pay for it with calls and not have any money involved. How's that work? Yeah, never mind. No, it is, actually another topic that might be valuable, and Doug Burgum, the governor of North Dakota, and I've talked about it. Both of us are struggling. It's a topic we brought up years ago, Patrick, about hedging against oil and volatility. It is certainly a topic that we explored at the Sovereign Conference with Mexico that does a pretty good job of doing that. But I don't think there's been any appetite in Wyoming to put hedging in place on any of that stuff.
Well, Mr. Chairman, I think 2 people asked me about hedging our oil just this last weekend. So,
Yeah.
I don't know what the appetite is, but I basically said that the companies basically hedge their oil out for 3 years just to get capital to drill. So in a sense, we're hedged to that extent already, but the companies are doing it and we're not involved.
Yeah.
Mr. Chairman, I vividly recall at one of your annual Treasurer'S conferences, a professor from the University of Wyoming asking us why we weren't hedging oil. And this was, I think, right when it was 140 or something like that. But I actually have the great pleasure of working with Governor Burgum in North Dakota, and actually I'm working on this project to help them look at hedging options. And I do think that it's certainly something that's worth exploring.
Yeah, and so if there's a topic that the IFC could look at, I would appreciate that. Thanks. Go ahead.
Mr. Chairman, I have no strong feelings either way, but I thought I had heard that maybe it's traditional that we do go ahead and take the vote, even though it is a vote of inaction. That makes it sound negative though, and I don't mean to.
I'm trying to remember. I think this was mostly an informational.
Lisa, you did I think, prepare a action asset allocation on D2. And is that what you were talking about earlier?
Yes, Mr. Chairman, Mr. Treasurer. Either way is fine. Really, the purpose is to just make sure that we have the directive from Slib. And if Slib just doesn't make a motion on it, we'll stick with the asset allocations from last year, and that's fine. But they may make a motion on it. And, the recommendation was just to stay the course and not make any changes.
So Lisa, was your intent today, and I guess I don't remember how it was noticed. Was it noticed as a public meeting where we could take, so a motion could be in order if you wanted? That sounds fine to me. And I'm trying to remember what the statute requires. It requires that we have quarterly updates and annual performance review. I sort of thought it was, we had talked about an asset allocation and whatever it was.
Yes, Mr. Chairman, that is annually as well. And
Okay.
within the approval statute for the IPS is the approval of groupings. And historically, we've done the grouping first, and then we've built the IPS around that and then brought it for approval. So
Okay.
either.
So if that's the case, then I would entertain a motion.
Well, Mr. Chairman, I would, the treasurer recommends that the board approve the asset allocations as recommended by the State Treasurer's Office, RBK, and the IFC.
Motion's been made. Is there a second?
Second.
Any discussion? All in favor signify by saying aye.
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 That motion carries. Very good. Thank you. Is there anything more to come before the board today?
Mr. Chairman, I believe that concludes the agenda for today's special SLIB meeting.
All right, thank you.
Okay.
Thanks, everybody, for being on today. And thanks for your work. And with that, I would entertain a motion for adjournment.
So moved, Mr. Chairman.
Moved by the auditor. Is there a second? Second. Been seconded. I'll recognize the superintendent. All in favor signify by saying aye.
Aye.
We are